Shares of Ares Management popping after reporting earnings this morning. The company seeing higher profit and revenue in the third quarter, benefiting from improving credit quality, record fundraising, and increased investment activity across the platform. CEO Michael Arrighetti joins us exclusively to discuss. Good to have you here at Post 9. Fresh off the earnings call. It's great to be here,
Sarah. Yeah, we first earnings call that we ever did from the stock exchange today. So. Happy to be here.
It's a good tradition because then you can come right here and talk to our audience. So what is driving the growth, especially in the fee business, which was really strong?
It's been so broad-based that I'm just unbelievably enthusiastic about the results and trajectory. If you look at fundraising, we had record fundraising. We came into the year saying we might have a chance to beat our prior record, which was $93 billion. We just put up a $30 billion quarter, $105 billion raised last 12 months, and that's strength in institutional fundraising, but also wealth. So we had a record quarter in our wealth business, raised about $12 billion year to date there as well.
Is it something that's happening in the markets right now, or is it part of this bigger sort of structural shift you and I have talked about toward private markets right now?
I think you've got long secular tailwinds in private markets. We've been a big beneficiary, and if you look at all of the high growth, high conviction areas, private credit, wealth, insurance, digital infra, we're kind of hitting on all of those themes. The bigger getting bigger. You're seeing market share consolidation. You're seeing LPs allocating more money to fewer people. You're seeing deals and capital flow to the large platforms. So I think it's a confluence of all of these things. I think we've been really well positioned. We've made real significant investments in growing distribution and deployment. We actually had a record deployment quarter too. Put up about $40 billion of
Where's that
investments.
going?
It's been everywhere. Secondaries was a big quarter for us. Digital infra, asset-based finance, private credit.
Private credit. So I'm sure you've gotten the question about the cockroaches.
I hadn't heard.
Is there a reason to be concerned about it after the bankruptcy of the parts company and the auto loan company?
Look, I know you may be tired of talking about it, but I'll give you my perspective because we've been in the private credit business for 30 years. In my 30 years of experience, I've actually had one experience of fraud. So it is kind of a bizarre thing to see this much coincidence. But when you look through the numbers, there's no data to support that we're late cycle. I look at our credit books. We've got non-accruals at fair value at about 1%, 1.8% at cost, which is well below historical averages. Loan to value's low, EBITDA is growing.
It's not like speculative activity where everybody's chasing these deals.
No, you just don't see it. And when you look at bank earnings, you saw flat loan loss reserves. When you look at the card companies, you're not seeing any increase in delinquencies or charge-offs. So, you got to look at the data. There's something happening.
Well, is it underwriting standards? Have they fallen? Because that obviously is the concern, that there's such a torrent of credit being put out there that people are not doing the work that they might have.
It's possible. These are specific instances and parts of the market where I think the risk of fraud is higher.
Yeah.
Trade finance, non-prime consumer. So, that might be something. We talked about this on the earnings call. It could be you have people wanting to get access to private credit because it's such a big part of the growth narrative in private markets that they're pushing in a little too quickly to corners of the market that they don't understand. It could be that underwriting standards for those folks have relaxed, but private credit's a very concentrated market. 65% of capital is in the hands of the largest managers. It's also noteworthy you're not seeing a lot of the big incumbent names show up in some of these stories.
No, you aren't. Although there continues to also be this concern that perhaps you're pushing out unrealized losses and taking pay-in-kind securities instead of interest payments. Address that if you can.
Yeah. So PIK is, again, part of this narrative. The way we think about it is you have to differentiate between pay-in-kind at closing, where you're trying to give a borrower flexibility to grow, right? Invest cash flow and growth rather than debt service, versus PIK that comes because you have a borrower who is liquidity constrained. All that being said, the one thing I always try to get people to focus on is that these private credit exposures are very high up the balance sheet, right? So our corporate exposures in the U.S. sit at about 42% loan to value. What that means is there's 58 cents of enterprise value below us. So even if you're taking PIK to accommodate a borrower, you're at the top of the capital structure and you're effectively eating into the equity. Right? So if you want to start talking about private credit losses, you have to basically see the private equity industry, lose all of its capital. And I think people don't really appreciate that structural nuance.
That's the other sort of worrisome narrative, is that lenders are starting to protect against lien subordination, make sure they're first in line before the next guy. Is that happening underneath?
I think in the broadly syndicated loan market, a lot of liability management transactions that you've seen, that is a reality of the structure of that market. I think people have learned how to navigate that, and it's priced into the risk in that market. In the true private credit space, that's just not part of the structure of the documents, and so you're just not going to see a lot of that. I think when you talk about trade finance, which you're beginning to see, collateral monitoring and making sure that these borrowers actually know where their collateral is and who they pledged it to, that's just a completely different part of the market. But in core private credit, that's just not part of the conversation.
What about the move to get your private investments into 401ks? It's obviously a huge tailwind for you and for your industry. What are your expectations here?
Look, it's happening. The wheels are in motion. Obviously, we've had an executive order, and people are now beginning to line up around product formation, potential partnerships. I'm excited about it. I think that broadening access for individual investors is a good thing with the right governance structure around it. Again, I remind people this is not necessarily transformational for the industry in the way that people think it is, because what it's really doing is just diversifying our fundraising channels. So if I at Ares raise $1 in a 401k or $1 in a non-traded product or $1 in institutional, I still have to find a great investment to put it into. So we continue to be focused on, can we originate differentiated investments for our investors? And then obviously the diversification is a good thing for Ares, and the access is a good thing for the individual.